is Commodity Wrap. I'm Tony St. James. Brian Hoops is president, Midwest Market Solutions. And Brian, seems like you and I talk nearly every day here, whether it's on RFD TV or here on Rural Radio 147. But for those who don't get to talk to you very often, we'll give some information, contact information in just a bit, and they'll have the opportunity to talk with you as well. You and I had the opportunity earlier to kind of recap that World Ag Supply Demand Estimates, or WASDE report. A few things that kind of jumped out at me as being somewhat bullish. I thought there was some bullishness in the corn number and also in soybeans. Is it just me, or was it somewhat positive?
It wasn't a bad day overall. You look at the report that came out yesterday, and the two things that stood out as bullish were soybean oil exports and corn exports. And you look at the trade today, and those are the two things that closed lower. Corn down about a penny, and bean oil 27 ticks lower. So people probably scratching their head about why that is. And the market is called futures, and it has a great job of anticipating what's going to happen in the future. And I think one of the things that happened yesterday was we anticipated with higher prices that corn report was going to be bullish and the soybean oil report was going to be bullish, and we did find that out, and then kind of confirmed what the trade had already anticipated. Now, we did see some early morning buying in the corn on continuation of that bullishness, but by the closing bell, it looked like maybe there's a few people wanting to take wanting to take profits than are wanting to buy at this price level. So, longer term, the fundamentals will win out. And so what are those fundamentals? Well, we're seeing ending stocks tightening up a little bit in the old crop. We don't really ration demand. We're not at that stage. It's not that tight. But we do need to plant more acres. And we talked about this a little bit on TV this morning. We need to plant more acres in 25 so we don't get into a tight squeeze. We need to plant enough acres to grow a big enough crop that we can build back a really comfortable level of ending stocks. And I think we're going to see that in soybeans this year. Soybean stocks are over 100 million more than a year ago. Wheat ending stocks are about 100 million more than at this time a year ago. So it suggests that the corn market, the one that is getting smaller ending stocks, that's the one that we need to plant more acres, rebuild some of those stocks throughout the course of 2025.
So a couple of questions, I guess, follow-up. Earlier this morning, you mentioned 94 million. Is that the number I remember?
I did mention that. I think I threw it out there that in our history, we've planted 94 million acres or more only 4 times in history. And so it has happened, but not that often. The biggest acre amount that we've ever seen was 97.2 million, and that was back in 2012. We lose a fair amount of acres every year because of cities expanding and people turning into farmland, into gas stations, golf courses, whatever. But we do need to plant more acres. And so I fully expect we're going to be above that 94 million this next year, maybe 95 million or more, as I think if this plays out with a good crop in South America, which is what the USDA is saying and what the market's anticipating, prices will work lower in January and February, but corn really shouldn't work as low as soybeans, and there's going to cause a disparity in prices. Producers, I think, will look at those prices and say, I have to plant corn this next year because there's better pricing opportunities and there's better potential for me to have a really good yield, whereas I could have a good soybean crop and it won't change my balance sheets that much, but a really big corn crop potentially could.
So I look at December 25 futures at 444, settling higher on the session Wednesday, and just wonder if we get up around that 94 or 94 plus, can we hold that 444, or are we putting pressure under prices when we grow that much corn?
So we probably need to put that premium out there, that 444, 450, 460. We need to have that carrot dangled out there to see those 94 million acres of corn planted. So it's going to be there as an incentive, I think, through the spring until we get into March, April timeframe when we plant corn across the Midwest. After that, it's probably going to be time to be hedged, because then you're starting to talk about weather once again. And if we have a weather issue, prices can really skyrocket. If we don't have that weather issue, prices will no doubt deteriorate. But I think 450 and above is prices that you want to protect. I could see, and I think you could make a case that prices maybe move up to $5 to track those acres. But during the time from now until March, early April, we're going to see, I think, that December corn be steady to higher here.
In other words, take the opportunity when it presents itself, and one opportunity that's presenting itself right now is to go to a break. So we'll take that opportunity. We'll come back in a moment. We'll talk proteins with Brian Hoops, and this is Commodity Wrap. Oh, my Lord, that was right at 6, wasn't it? Brian, he's a pro.
We've done this once or twice.
Yeah. I have to pay you extra for this.
I don't think so.
All right. This is Commodity Wrap. First segment, we had Brian Hoops on the phone with us. Brian is President, Midwest Market Solutions, and just so happens we kept Brian around for the second segment, so we get 2 for the price of 1 today, and we're talking proteins. We went pretty in-depth on the corn market in that first segment, but now I want to look at cattle and hogs. 191 cash cattle in the South, a lot of that finished up on Tuesday ahead of the trade on Wednesday. And then at the end of the session, we see higher for live and feeder cattle as well. Is that moving in response to that 191 cash?
It certainly is. And around midday, we had some reports of 300 cash on a dress basis. That's fully $3 better than a week ago. So given those numbers, we were just too cheap coming into the morning session, and we rallied. And we rallied sharply off of that news. And I think we maybe are getting closer to being done with this rally than following through with several dollars more to the upside here. You look at December, just because it's in deliveries right now, or in the delivery period, cash at that 191 area, when we were trading one in the upper 180s, 190, wasn't any threat about any deliveries. But now with this big rally we've seen, we're trading above the cash. There's where you can start talking about maybe people wanting to deliver, especially if we see another dollar rally tomorrow. There's a very high incentive that there will be some deliveries starting against December. And usually once you get into that point where then the futures starts to stall out. So, producers in here, I think, have an interest in selling at these new highs. I think they should have an interest in selling at some of these new contract highs in a lot of these cattle, maybe at least on some short-term hedges, get them through the winter months. As we get into the second quarter, most likely we're going to see prices react to even higher levels as supplies tighten up even further.
So, Brian, we pick up this WASDE report for December, and really, when you look at the numbers for cattle, for hogs, nothing really surprising in there. It seems as though USDA tells us what we already know. 1, we're going to have tighter supplies going into 2025. 2, we'll have less to export. 3, we'll be importing more beef, especially for ground. 4, lighter weights on hogs. 5, chance to export more hogs in 2025. So I don't think any of that's earth-shaking news there, but does it just kind of reinforce what we've already been thinking?
Yeah, I think it certainly does. This is kind of a confirmation of what we've been anticipating. The question that I think the only question we've had in our minds is, will consumer demand hold in as these price levels move higher? Are we going to have the consumer, will they react to these higher prices with pulling away from demand? Well, we've seen decent exports at least, so maybe U.S. consumers have backed away a little bit, but our exports have improved quite a bit. When we look at our boxed beef sales on Monday mornings or Monday afternoons, we see really good sales in the last couple of weeks.
Okay, I'm going to throw one that seems like a curveball, but almost seems obvious to me. Ghana. When we start looking at other economies, that's not an economy we normally talk about as an export partner. But I do know that part of what this new administration is going to want to do is start picking up where they left off 4 years ago with some trade deals and really focusing on countries like Ghana, where the GDP growth hit a 5-year high of moving 7.2% higher. How important is it going to be to find some of these new and emerging markets, whether we're talking about beef or pork or row crops?
So, yeah, as China seemingly backs away from doing anything with the United States, it's going to become more and more and more important, I think, for us to have different trading partners. And I think we want to open up some of those U.S. export markets. That's going to be one of the keys, and has been for quite some time. I know some people have pointed towards places like India, where the population has grown dramatically, that maybe we will see that market open up. And I'm very skeptical that India will ever open up their markets to the United States. China's the biggest trading partner. Getting a fair trade agreement with them would go a long, long ways, I think, to us as far as benefiting the U.S. farmer and as well as livestock producers on the export potential to China, and replacing them would be very, very difficult.
Well, Brian Hoopes is president of Midwest Market Solutions. If you want to talk one-on-one with Brian, how would we do that?
You can call me directly, 417-501-5132. You can go online to MidwestMarketSolutions.com.